Right, well, hello everyone, and thank you very much for attending the second in the ByteTree Asset Management Bitcoin and Gold in 2022 series. A couple of points of order before we start. This is not investment advice, it's purely entertainment with a view to enlightening us all about the world of finance. Secondly, there is a Q&A button. Please feel free to stick in your questions, and we'll either sort of filter them in during the conversation or address them at the end if we have time. This will be recorded. You can find us on our YouTube site, the ByteTree YouTube site, where past webinars will also be shown. And do sign up to our newsletters so that we can give you the heads up in advance for future calls. And with that, we're delighted today to welcome Duncan MacInnes to chat with us. Duncan is investment director at Ruffer Investments. He's the co-manager of the of Ruffer Investment Capital, which is listed on the London Stock Exchange. And of course, he is the author of the very famous, well, certainly in the UK, Bitcoin trade of 2020, and we'll be talking about that later on. We're going to sort of discuss broad macro today, what's going on in terms of inflation, what this means for portfolio construction, and then more specifically, of course, we'll be talking about Duncan's views on gold and Bitcoin specifically. And I read in the latest annual report that at Ruffer, we always focus on capital preservation and eschewing the mania. Duncan, welcome. Thanks so much for joining us. This is a good time, I imagine, to be eschewing the mania.
Yes, yeah, it is, and it also, it's an interesting. It always is viewed as a contradiction that, as a firm that sort of does pride itself in eschewing the mania, that we got involved in Bitcoin in the first place. That was quite the contradiction for a lot of our clients and shareholders to get their head around.
Yeah, I'm sure there were some extremely interesting conversations.
Yeah.
But we probably all agreed that we live in strange times, in particular with regard to inflation. Inflation numbers are at levels they haven't been at for decades. But the debate rages. Is it transitory? Is it here to stay? What's your sort of interpretation on what we're seeing out there?
Yeah, so the transitory debate, I think people are kind of sick of it now, aren't they? I remember more than 6 months ago sort of writing that the transitory debate sort of missed the point. Of course, prices can't rise at the rate that they were rising at. House prices can't go up at 10 or 20% annualized forever. But the reason it misses the point is because what comes out your pocket is the price level, not the sort of rate of change, which is what inflation is all about. So even if inflation does recede slightly, that doesn't mean people have not been made poorer in real terms. But anyway, I think the debate is sort of settled that inflation is not transitory. For a long time, Team Transitory were pointing to sort of one-off COVID-related spikes. I think the first one was lumber, then it was used cars, then it was microchips, but now it's lumber again, it's still cars, it's houses, it's oil, it's Rolex watches, it's wages. At what point do you say, wait a minute, these aren't one-off spikes and this is actually a trend? So yeah, we don't think it's transitory, but actually we might also be wrong. But the bigger point, I think, is that inflation volatility is here to stay. So we're going to get more inflation and more disinflation than we had previously.
And Duncan, the latest one is oil, and oil's or energy more broadly. Yeah. We've got the shenanigans in Russia and Ukraine, obviously, but notwithstanding that, there's been low investment for years. This is the input cost to everything, and as I always like to say, that when you have a sandwich with bread and something in the middle, economically it's oil. If 7 billion people in the world try to try to feed each other without oil, then actually our sandwiches would be pretty small. So this is the input cost to absolutely everything, and this is pretty structural. So, I think that the confusion for people about Bitcoin and gold and inflation is why gold didn't play and why Bitcoin was late to play, and then why Bitcoin's not playing now. You know what I mean? So,
Yeah.
sort of people almost want I think what they're saying is, when they're confused by it, they're saying, well, go and buy an inflation swap, which exactly matches the thing that you're talking about.
Yeah.
But this is broader, isn't it? It's assets that tend to respond to an inflationary world.
Yeah, I mean, well, so gold was the most obvious disappointment last year. I think if you had perfect foresight into the economic reality of 2021 and saw money printer go burr, massive deficits, failing trust in institutions, and then this huge inflationary impulse that surprised everyone, or certainly its duration and probably the extent of it surprised everyone, even people like us who were talking about inflation. And then you knew that gold fell 5% and the gold miners fell 10 and the junior gold miners fell 20. You would be pretty disappointed, because you would have been pretty high conviction that gold would have done well. And I think gold is sort of it's testing the conviction of its supporters, because it didn't really work in the last couple of major market sell-offs, and that was something that we experienced as we've got gold in the portfolio, and then it didn't work as an inflation hedge. And I think the jury's really out as to why that is. Bitcoin taking some of the shine off it is part of the answer, but I don't think it's the whole answer. You've probably seen it. JP Morgan have done some good work that sort of shows flows out of the physical bullion ETF match flows into Grayscale, the Bitcoin trust. So I think that's part of it, but it's not a sufficient answer.
Can I just take a quick step back? You say that the conversation about transitory versus not transitory is settled, but we picked up something from one of your reports, and I want to ask the question: the conversation might be settled, but has the market caught up, if you like? And what I'm going to do is just quickly share this slide from you and talk us through that.
Yeah, so this is a great slide. So full credit for this slide goes to Jared Minak. We subscribe to his work. I just think this is great. So what it shows is US headline CPI over the last 30 or 40 years, and then what the inflation swaps market was telling you at two different points in history. So the orange line is what the inflation swaps market was telling you, essentially the market forecast of inflation at the COVID bottom in April 2020. And it was saying, look, we're going to have deflation in 2021, and then over the course of the next few years, we'll gravitate back to 2% inflation, because central bankers can work their magic and tweak the economy to get just the right level of inflation back to their long-term target. That was, of course, hideously wrong, because we didn't have deflation in 2021. We, in fact, had this huge surge in inflation. It's a 7% miss, as you can see on the chart there. But then you look to December 21, the blue line, and it's telling you that, yes, we're having high inflation right now, but don't worry, central bankers have it all under control. And looking a couple of years out, as the blue line sort of tails off, we'll be back at that 2% long-term inflation target that everyone desperately hopes we can get back to. And so I think it's remarkable how complacent the market is in the face of such a glaring error in recent history, that it can now continue to forecast gravitating back towards 2%. But it's not just this. There's other sort of market signals that tell you that long-term, the market is very complacent about inflation. Now, we all know we're talking about inflation in the short term, but it's really long-term inflation expectations that are important from an asset pricing perspective. So you've got what you can see on the chart here. You've also got global bond yields are very low everywhere, all negative in real terms, really. I think you've got $10 trillion still of negative yielding nominal debt. And then when you look at the sectors of the equity market that would be the strongest beneficiaries of inflation, so I'm thinking energy, financials, banks, and property stocks, well, these are actually the cheapest sectors of the market. So again, that's showing that there's no investor demand to sort of hedge inflation. And like we just mentioned, the gold price isn't exactly very perky either. So I don't know, I mean, maybe it's a bit of a reach to say, but perhaps Bitcoin's rise has been more to do with the technological aspects of Bitcoin than the inflation hedging aspects. In fact, I don't think that is controversial to say, really.
Yeah, because the long-term expectations of inflation have never really changed much.
Yeah,
and there's this acceptance that the world as we know it, the financial world it works, and everyone believes that. If you work for the IMF or whatever, and you're talking about developed economies, we assume it works. If you're talking about certain emerging economies, then you accept that it might not work. But if everyone obeys the rules, it will work for them too. But we know from what you've just shown us, that last slide, that in the short term, it's always wrong. It's either it's just the sentiment reflected in an extraordinary way. And the swings in the cycle of asset prices is more to do with sentiment and the PE ratio, if you like, the valuation, than it is the fundamentals. So often than not, so much more than not. And so it is extraordinary. And I think that what you're suggesting is that the long-term expected rate of inflation might be wrong. And if it's wrong, then inflation-sensitive assets are underpriced.
Yeah. In a nutshell, I think that's exactly right. And there's lots of reasons why inflation might be higher over the longer term, but it ultimately acts as the sort of least painful solution to the world's biggest problem, which is that we're drowning in debt. So higher inflation is we think the ultimate end game, and the fact that it's available. It is mispriced in asset markets makes it pretty compelling to us. If it was priced in, then you'd have a different problem, but it's not priced in.
So, I mean, looking at Ruffer portfolios, what made you decide in 2020 to put Bitcoin in? Now, I know you don't like speculation, but I would argue that in 2020, Bitcoin wasn't very speculative because it was obviously underpriced. I mean, we were saying it at the time, and it was pretty calm and it wasn't very volatile. But then it quickly became overpriced in 2021 and it became volatile and the volume went up. If you just think about the volume as speculation.
It's all relative, isn't it? You say it's not volatile, that's because you are a long-standing owner of Bitcoin. But I think the range of Bitcoin in 2020 was probably 3,000 to 19,000. So it was pretty volatile. But yes, so I think our thinking, it comes back to what the really big picture view for us is. We've entered a new economic regime. We're worried about higher inflation. We're worried about financial repression. And from a portfolio perspective, we think that cross-asset correlations are going to are changing. We're seeing that in front of our eyes. And that the portfolio that you need for the next decade is going to be very different from the portfolio that would have been optimal for the last couple of decades, the sort of the balanced portfolio, the 60-40. Add on top of that, expected returns for assets are very low across the board. We know with certainty what they are in the bond market. We know that equity valuations are very high, and that probably leads to lower future returns. So all of that sort of cries out for an answer. And in the land of the blind, the one-eyed man is king. If you sort of put your beer goggles on, then it might mask some of the less attractive features of the crypto landscape. And Bitcoin can look like an answer to a lot of these problems. Now, the first real experience I had of Bitcoin was in 2017, where I happened to be, ironically, in New York at the Columbia University value investing course. And ironically, it was December 2017. It was the absolute peak of the 2017 bubble. And all we could all do at this value investing course was talk about this thing called Bitcoin, which is the opposite of value investing. And I remember sitting at breakfast one morning, listening to a guy next to me who was a former Miami real estate broker turned crypto speculator being interviewed by a journalist. And it just looked and smelled like a sort of crazy bubble. And in hindsight, it was. Now, fast forward to 2020, and I think COVID sort of changed everything in terms of the economic landscape and in terms of the accelerating the digitization of everything. We were all locked up at home. Vast monetary and fiscal policy response to the virus all of a sudden made the idea of a sort of hard cap supply, digital gold, digital money seem like a pretty good idea. and we weren't alone in thinking this. We sensed quite early, I think, a wave of institutional adoption was sort of starting to get going as an alternative asset class, as something that was a little bit different from the other asset classes that are more highly correlated. And we started to sense that Wall Street was changing its tune on this, and that it was realizing crypto in general, not just Bitcoin, is an opportunity, not a threat. And that would get it over, that would help push Bitcoin over what I sort of called the credibility hump. Because as you guys know, there is a really big credibility hump, and there's a lot of ingrained opinions that needed to be overcome. So anyway, that in a nutshell was sort of the thinking. I sort of tabled a paper in the middle of 2020 saying that we should take some of our gold allocation and move it into Bitcoin. It took a while to convince some of my colleagues. Some were sooner convinced than others. And by November, I think that institutional adoption trend was stronger. You had Stan Druckenmiller, you had Paul Tudor Jones, PayPal, Morgan Stanley. It really was starting to get momentum. And so then we had to discuss how to do it.
Before you get to how to, the adoption hump, I think that's a really good way to describe it. And having others show the way, lead the way, was actually quite helpful, I imagine, in getting colleagues over the line. I mean, how in a place like Ruffer, which, you know, for those who aren't familiar, it's a sort of pretty old school British asset management firm in its approach, and you probably still use phrases like gilt-edged securities and things like that.
So I think actually that our investment in Bitcoin has hopefully woken up clients and people in the industry to the fact that I don't think we are like that. To be honest, I think that is the reputation.
That is your brand. It's on the internet with the
dog. That is the reputation. But we've been using derivatives, volatility call options, equity puts, credit default swaps, payer swaptions, interest rate hedges. We've been using some pretty sophisticated stuff since I joined Ruffer. Not that it's me that does it, but coincident with when I joined Ruffer in 2012. So we've been doing that for a long time, but I think the Bitcoin investment really did make people sit up and think, oh, wait a minute, stuffy old Ruffer is doing some pretty funky stuff there, and some of it has worked relatively well.
Which is hugely commendable, by the way. And we're obviously massively on your side. And I think it's probably worth highlighting that I think I've been following Ruffer for a long time, and I think one of the reasons you started doing those wacky things in 2012, having been into traditional assets pre-crisis, was because I think the firm was early to realise that the bond market was no longer going to have the anti-fragile qualities that it once did. So you had to get and be pretty innovative.
That's exactly right. I think
well played yet again.
And this is why Bitcoin, I think, potentially has the the famous Ray Dalio description is Bitcoin is an option on a future store of value, and I think that's a really nice shorthand way of thinking about it. And the problem we identified way back then is the post financial crisis zero interest rate world. It was now becoming increasingly difficult to find positive carry protection assets. Back in the glory days, pre-financial crisis, you could have owned Swiss bonds, Japanese government bonds, US government bonds, and they all had nice positive carries, and you knew they would go up in a crisis. That doesn't exist anymore. So we've we've had to develop expertise in what we call our unconventional protective toolkit, and that does include credit default swaps, options, and so on. And Bitcoin was another part of this toolkit. Clearly, it doesn't have positive carry, but it does have different correlation characteristics that we thought would be useful from a portfolio perspective. On
that note, Charlie, should we bring in ByteTree's manual app and see what Duncan thinks of our explanation? We'll let Ruffer see our top secret asset allocation model. There you have it. So as we go into a high inflation world, then hard assets are on the top and financial assets are on the bottom. And on the right-hand side, we've essentially got risk on, as demonstrated by rising bond yields, and risk off by falling bond yields. And I think, you were saying earlier that the next 20 years or the next 10 years is going to need a very different portfolio approach than the last 20, which has, rewarded financial assets which are clearly below the line. So if our magic long-term inflation expectation starts to shift higher, which I think it will, and I suspect many at Ruffer think it will, then above the line is pretty interesting, isn't it?
Yeah, I think I have seen this before, but I hadn't seen it framed this way until I saw you do it. I think it's interesting because I do think it's maybe right that Bitcoin is in a different quadrant than gold, because you do have to have more risk appetite to embrace Bitcoin. I mean, there's no doubt about that. So perhaps the sort of animal spirits that comes with being on the right hand side of that chart is necessary for a positive Bitcoin price experience, whereas gold is clearly more defensive.
And I think one of the interesting things about that simple model, and of course it's a simple model, it's a two-factor model, is that the opposite of Bitcoin is a US Treasury, basically, or a government bond, and the opposite of gold is a tech stock, and that sort of feels about right, doesn't it?
Yeah. I think that's fair.
So as Russell Napier actually was on the same theme of radically changing the way you think about portfolio construction. Is that kind of mentally quite a difficult job, do you think, for the institutional manager who's been sort of wedded to a 60-40? We've got a great question in here, which is, we're seeing huge growth in Web3 at the moment. Are these the sort of things you're looking to try and get exposure to?
So I think there's probably two questions there. Does the way that you think about portfolio construction have to change? Yes, definitely. And I think I probably have some mildly interesting things to say on that. Do I have anything interesting to say on Web3? Probably not. So we haven't really looked much beyond Bitcoin in the crypto universe. I mean, I have a little bit, but certainly there are people out there who know far more than I do. I tend to just draw a fairly simple distinction in that Bitcoin is a useful alternative asset. That digital gold heuristic is a useful starting point. Everything else in the crypto ecosystem is more like venture equity. That is a very simplistic distinction, but we're not venture capitalists. We're not in the weeds in terms of the technology. So we have not ventured there yet, and there's not any plans to. But I wouldn't rule it out long term. If crypto fulfills its potential, then it will sort of become essential. But to go back to the first question, which is about portfolio construction, people find getting their head around the death of the balanced portfolio, the death of 60-40, really difficult because it's worked so well for so long. And also the industry has been built up around benchmarks. And therefore, even if you wanted to significantly deviate from those standard allocations, that would not necessarily be that easy. And so markets have been distorted by a decade of QE and zero interest rates. And the problem is that when you distort the risk-free rate, you distort everything else on the curve, because it's the most extreme point on the curve. And then you supplement on top of that the rise of passive as well. And you can see how people have got into this position. So what do we do instead? Well, we absolutely cherish the fact that we have this blank canvas of being totally unbenchmarked. And that allows us to sort of take strong views and boldly express them in our asset allocation. So over the years, we've ranged between 20 and 65 in equities, or 0 today in government bonds versus 60 or 70% pre-financial crisis. But in general, we do have a conservative approach, as Charlie suggested. We're not return maximizing, we're regret minimizing. So we're trying to build an all-weather portfolio that can weather what we think is the most likely scenario, but also the what if we're wrong scenarios.
And over time, that's beaten the market, which is remarkable.
Yes, so the track record is pretty long now. It's 27 years, and we've annualized at 9% after fees, which is in line with the MSCI World. I think it's slightly ahead of the MSCI World. It's well ahead of the FTSE, including dividends. But I think the thing we're most proud of is actually the risk management. So 9% per annum is great, but across 27 years, 3 bear markets, a couple of 3 recessions, the max loss is less than 10. So the peak to trough loss, being less than 10 is pretty good, and then that leads to a good Sharpe ratio if you're into that sort of thing.
Well, it's if you make loads of money, then and you don't actually care about making loads of money because you've already done that, you're just trying to protect it in real terms, then it's exactly what you want. And you want to be able to sleep at night with not seeing huge drawdown. So I can see why it's a big market for it.
Well,
but getting back to your point about market portfolios and balanced portfolios, there's been a regulatory pressure to push these things, and they're seen as the least risky thing because the career risk, they're very low. Russell Napier in last month's excellent webinar with ByteTree was saying that you need to put all your assets into 15% of the market. Yeah. Now, equities have become $125 billion asset class. I think gold's a $10-12 billion asset class.
Trillion.
Yeah.
You're showing your age.
trillion. Yeah, quite right. And then Bitcoin's less than 1 and stuff. And he's basically saying, and then bonds are huge and everything. Yeah. And he's basically saying that you want to have all of it in 15%. And so to be in the areas where people aren't, and Bitcoin and gold are in those areas, as are some other wacky things, which would sort of make sense to us. But thing about Bitcoin and gold is they're the 2 liquid asset classes.
Yeah,
there aren't many liquid assets that are in the 15%. There's most liquidities in the other group.
Yeah, I think that's exactly right. And so Russell's webinar was fantastic. In fact, the reason I'm on it is because I'm on this today is because I messaged you to compliment you on that great webinar. So I think Russell's right. Your GMO have a very similar message, that you really want to ignore a very large part of the equity market and focus in, for them, I think it's emerging markets. We would agree. But the dynamics of that are really, really quite interesting. So just sort of thinking about the equity market specifically, as kind of to your liquidity point, the entire energy sector is something like 3% of the S&P, just under. And then you've got the giants of Apple and Microsoft at 5, 6, 7% each. So if you just think about the mechanics of that, if Apple is to fall 20%, that knocks more than 1% off the value of the S&P. For the index to stay flat, the energy sector has to go up 30 or 40%. And one of my favorite stats is that Elon Musk's net worth is greater than Exxon's market cap. It is remarkable how these energy businesses, which are the inflationary beneficiaries, have shrunk, and the technology businesses have grown so much. And I think I'd have a lot of sympathy with that the less your portfolio looks like the benchmark, the more likely you are to sort of thrive in the coming period.
And as we've been speaking, Brent crude oil has gone through $90.
Wow. Yeah.
Here we are. And only a year and a bit ago, it was what, minus 37.
Yeah.
Which is the price you get when you run out of storage and there's no one flying around the world.
Yeah.
Which is really quite an extraordinary thing. And I think that when we think about Bitcoin and all these sorts of things, there are so many different arguments. You've got the energy side of it, the ESG, and you've got the sort of internet credible competitor to gold. Then you've got head of crypto, the dominant asset within the crypto sector, which I think you very eloquently described as more of a tech trade and not rather than a monetary trade. But there are many different things that we can look at here. I mean, how did you tell your colleagues at Ruffer that Bitcoin was a good idea? I mean, what was it that convinced them?
I think it was a combination of what I said earlier, really, about the macro setup in the middle of 2020 with the rampant money printing and the fact that everyone was locked down at home just made the idea of digital gold much more attractive. And then you lay on top of that the monetary and fiscal stimulus that we were experiencing made the hard capped supply element of Bitcoin relevant, very, very relevant. Plus, you had the sort of shorter term macro trade or liquidity driven trade dynamic of implementation was very difficult, but you could see that the institutional wave of capital was coming. And if you could position yourself in front of that, then that would be really, really beneficial. And so it was nice because you could buy in and you sort of saw that the liquidity was coming, so you could get ahead of that. And that would buy you the time to wait and see if Bitcoin fulfills its potential. Now, what changed was that essentially, I think the price went up too fast. When we sold it, I wrote an article called "The Future Arrived Early." It would have been nice if we'd made 300% over the course of a few years rather than a few months, and that would have allowed us to sort of watch the ecosystem develop. But given that we bought it as a digital gold, as an additional diversifier in our portfolio, and it was exhibiting those behaviors at that time in November 2020. By the time we sold in March, April, it was behaving more like a sort of NASDAQ leveraged ETF. And that was one of the reasons why we decided to exit.
Yeah, so when we think about Bitcoin's attribution, we're still quite difficult to know how much is the credibility of the asset, how much is just the sort of the PE, the tide coming in and out, how much is the macro. Yeah, we don't really know yet. When we do our best, I try every week to write about this stuff. I do my best, but we don't really know where we know so much more about other assets.
Yeah. I mean, it's very difficult to disaggregate, and we definitely should be talking about the sort of froth in the sector. But what's interesting is that the froth is not really focused on Bitcoin. So the froth, as far as I'm concerned anyway, the froth is really elsewhere in the crypto ecosystem. And then it's very hard to disaggregate, well, then does it matter? Does it matter or does it not matter?
I suppose it then begs the question, Duncan, what would persuade you to get back in?
I think it would be, it would have to be, so I have this sort of framework of thinking about the big, what I identify as the big risks. And the big risks are ESG, tether, China, regulations, and then the sort of liquidity or froth environment, froth around the space. And and it's interesting, I've never been involved in a sector or a stock or an asset class where the news flow is as relentless and as fast moving as Bitcoin and crypto. I mean, it was sort of all consuming my life in the middle of 2020 and early 2021. And so watching these different risks peak and then ebb was very interesting. So within that sort of framework, you can talk about each one if you want. But at the moment, the ones that sort of concern me the most are the froth and liquidity, and probably Tether as well. I think we're sort of past the peak of ESG concern. I think you might disagree, and we're past the peak of China concern. I think, and you might disagree. And the regulations are sort of quite hard to pin down, I think.
Yeah, I put out a piece today, and I think the title was along the lines of why Bitcoin is less risky than Microsoft.
I saw it, but I was in another meeting, so I haven't had the chance.
Yeah, but just looking at the pithy headline, what do you think of that? Would you rather 10 years for your kids' ISA? Would you want Bitcoin or Microsoft?
I would love to be able to buy Bitcoin in an ISA.
Okay.
That would have saved me a bit of tax in the last couple of years. Yeah. If given that choice, I would definitely take Bitcoin over Microsoft today.
So Microsoft, I mean, that's interesting because Microsoft, the second most owned equity in the world. I mean, that's the point, isn't it?
Yeah.
And we've been here before. It's got in the piece, it's got a 2.8% free cash flow yield, which is up a bit from a month ago before it started falling. In 1999, it went down to 2%. And in those days, it was growing at 30% a year, and now it's growing at sort of 14, 15 a year. And we're back to the same sort of level of valuation. And Mark, our producer in the background, was saying, yeah, they're doing this sort of crazy acquisition thing that, they bought the video games company again. I think last time they got into the Xbox business when they realized that growth was slowing, and now they're doubling down on that. And you just look at all these sort of repeats, and then you've got other people in the crypto space who say, well, everything on the internet is going to be challenged by crypto projects, and you have to worry about that whole thing. And so, you kind of look at Microsoft and think in 10 years' time, you've got a high yield conglomerate, and it's not hard to see that. Yeah. Even though its products are brilliant. Yeah. I use its products. And that's how the world is. It's ruthless, isn't it?
Well, so that I mean, comparing it to Microsoft or mentioning Microsoft in 1999 makes me think that I think the analog with crypto in 1999 is almost too perfect to end up being accurate. So if you think back to 1999, you were both there. You were both there, I imagine. So I'm probably speaking out of school here, and you'll correct me if I'm wrong. But all of the hopes and dreams, the promises of the internet, turned out to be real. The most optimistic optimist back in 98, 99, selling you a tech fund, was right. They were spot on. And people couldn't have imagined the things that were subsequently spun out of all these internet companies. The fact that we've all got hugely powerful computers in our hands and all of the books and music at our fingertips. And today, similar claims are being made about crypto changing the world, the metaverse, Web3, revolutionizing money, destroying the banking system as we know it, usurping the dollar, all these very grandiose claims. But there are also tens of billions of dollars of venture capital money being raised and spent. I don't know how many multi-billion-dollar funds Andreessen Horowitz alone have raised in the crypto space. There's a huge quantity of intellectual horsepower flowing from universities, from finance, from tech into crypto. And it is almost certain that there will be myriad, I would say, world-changing companies a decade from now that are born out of the venture capital spent today. So those parallels are so clear. But as you guys know, that didn't stop investors in Cisco and Microsoft and Amazon and all of the winners of the dot-com bubble losing 60, 70, 80, 90% of their money from 2000 to 2003. Yeah, that for me is the concern. And I suppose lastly,
Amazon 95, Duncan.
Yeah, and to echoes of 99, I mentioned it in the report. Jeff Bezos wins Man of the Year in 1999, and the stock then falls 95%. Elon Musk wins Man of the Year in 2021, and maybe the stock falls 95%. So I suppose the last thing is you never know, or we don't know at this stage, whether Bitcoin and Ethereum are the next Google or whether they're actually Lycos, Ask Jeeves, AOL, they're not the eventual winners. And I mean, sure, you've got an opinion about this, but it feels like maybe Bitcoin is now a sufficiently large network that it will be dominant and is here to stay. But I think that's still open to some debate. It's not fully settled.
Yeah, you did say in a chat we had last week, you said that whatever happens, Bitcoin's going to be part of the macro toolkit for years to come.
Yeah, so I think global macro hedge funds like big, liquid, volatile assets, and that's what these guys make their money on. And so I think the absolute worst case for Bitcoin from this point is probably that it becomes a sort of degenerate hedge fund gambling tool, and the sort of zero risk that we previously dealt with for years is maybe off the table, barring one of the cataclysmic scenarios like quantum computing or the code gets hacked and that sort of thing.
Mm-hmm.
So Charlie, should we just finish off with a bit of a gold and a balance, and then take it to questions, because quite a lot of good questions building up.
Yeah,
I just would say to people, if they're sending in questions, just remember that this is public, and when you're dealing with a security like the discount premium on Rika, that's probably a compliance issue to answer that question.
I can probably answer a question about the RIC discount if there is one.
Okay.
There is one actually. Yeah.
Wow.
Yeah.
But before we go there, should we do the Bitcoin gold? So come on, how are we going to balance Bitcoin gold? ByteTree has a methodology called BOLD, which is basically looking at the historic volatility. Now, you touched on volatility earlier, talking about the range, the price range in a year. So 2020, you were saying 3 to, I think it's 27 or something, which is a huge range, isn't it? It's 9x, whereas the range last year was actually 2x. So nothing, but the volatility as measured in financial terms, which is to do with daily price change and all that, was higher in 2021 than in 2020. So there's two different measures of volatility. Anyway, we use the latter, and looking at basically Bitcoin gold. If you look at price volatility, you end up with sort of 80% in gold and 20% in Bitcoin.
Yeah. So I think that if Bitcoin is to be successful, I think the journey will be towards one of much lower volatility. And I used to sort of, when I was talking to clients about this, when we had exposure, I used to always say, think of Bitcoin's reputation as a risk premium. And as we move through regulation, democratization, the normalization, the institutional adoption, the risk premium and the volatility of Bitcoin will compress, and that will have a significantly positive price impact. That's what success looks like for Bitcoin. I think it's on a journey to being low volatility like gold, and if it is successful, you are paid for wearing that volatility by the fact it will appreciate dramatically. And I do like the theory of, people say Bitcoin's too volatile to own, but you can fix that by just having a smaller position. Just you can calibrate that to whatever volatility you think you can bear, and by doing that in combination with gold, I think makes a lot of sense. And that's how we funded our Bitcoin allocation. So at the point where we decided to buy Bitcoin, we had about I think maybe 11% of the portfolio in gold and gold equities, and we took 2% of that and allocated it to Bitcoin. I think it's a sensible way of doing it.
And your money went back from Bitcoin to gold again. And next time you buy Bitcoin, it will come back from gold and out there. Or from Microsoft. Which one?
Yeah. I don't think it was quite as clean as that on the way out, but I think personally as well, I think that sort of way of thinking about it makes a lot of sense.
A couple of people have asked about the thorny issue of regulation, and clearly it's a major disincentive. Well, in fact, it's just very convenient for, I guess, institutional investors, particularly in the UK, not to have to bother with it. Do you have a kind of roadmap that you think about in terms of regulation and I guess it would be clearly very helpful if it was sort of approved in some shape or form.
Yeah, well, it's sort of happening, isn't it? I mean, it's easy to lose sight in all of the noise, and there is a lot of noise. But we've got an options market, a futures market. We've got ETFs in the US based on futures. We have the Grayscale holding company. Coinbase is listed on the IPO. So the crypto ecosystem is becoming ingrained in the traditional financial system. And that's important because Wall Street and venture capitalists have huge lobbying budgets, and they don't really want to kill the golden goose that they're earning lots of fees from. And they have the ears of politicians. So I think that's quite a big change from the rhetoric that you hear from, for example, Elizabeth Warren or Christine Lagarde, which of course gets lots of headlines, very negatively inclined towards crypto or Bitcoin. But I think underlying all of that, there is progress, there is momentum, where I think regulators globally are iterating towards recognizing that crypto is innovation, crypto is venture capital spending, crypto is probably good for the economy to some degree. And then also I think they have to realize that regulating Bitcoin is not very easy. Regulating crypto is not very easy, but what is easier is to regulate the on and off ramps. And I think that's ultimately where things will settle. So the onus will be on Coinbase to do KYC, Coinbase to know where your money came from, and you won't be able to take it back out until you've proven it, that sort of thing. And I think that to me anyway, maybe looks like the end game or where we head to in the next few years.
Yeah. Can I ask you as well, we haven't really touched on your gold allocation specifically. How do you think about that? Do you have a sort of valuation model, or how do you size it?
No, we don't have a valuation model like Charlie does, and I think it's impossible to value gold. But I think if you had to use a model, Charlie's one's as good as I've seen. I really like, it's sort of ludicrous to even mention it, but I really like the old rule of thumb that an ounce of gold has always been able to buy a Savile Row suit. And over 10 centuries, an ounce of gold has been able to buy a Savile Row suit. And if you did that today, you wouldn't get much of a suit. You might get the trousers, or you maybe get the jacket, but not the trousers. So what's gold today in sterling? Like just below 1,000. Sorry, just over 1,000. That doesn't go very far in Savile Row these days. So I think that sort of way of measuring gold is a very useful yardstick. But really, gold is a flow-driven asset and a sentiment-driven asset. So that's as important as trying to nail down a valuation on it.
Yeah.
Yes, I mean, I think that from my point of view, it's really the calibration to know where you are. I mean, fair value is a stopped clock concept, isn't it? I mean, you're right, twice a day or twice a cycle in the case of assets. But still, to know where you are is a very, very important understanding of risk and how badly things can go wrong. If something's cheap, then it can't go as badly wrong as if it's expensive. I think it's as simple as that. Cheap things don't go up and expensive things don't go down. So I think, Charlie, we've made quite a lot of the major points. I want to just say the institutional bump. So you saw some of the
credibility hump. It's the credibility hump. Yeah. I remember trying to speaking to a Telegraph journalist, desperately trying to get him to use this phrase because I thought it was a good one, but it didn't make it to the article.
The credibility bump.
Hump.
So Ruffer got over the credibility bump. Sorry?
Hump with an H.
Hump.
For hippopotamus.
Yeah, that's it. So the credibility hump, we're there. Now, why did no one else get over the hump in UK institutions? I know in America they've done a bit better.
Well, I think to a large degree, it's how difficult it was to implement. So remember, in the US, you've got Grayscale, You've got those futures and options markets that I mentioned, whereas in the UK you have none of them. In mainland Europe, you've got the coin shares, exchange traded products. There are different securities that or methods of implementation that you could use. We didn't really have them in the UK, and so when we were having conversations as to how to do it, it was not easy, and I think it's something that we're really proud of, that we managed to implement it, without having any market impact, getting our clients exposure, all of our clients exposure across all of our different vehicles, and it worked out quite well for us.
Absolutely, it did. Well, Charlie, let's ask these questions that are piling up.
Right. With the approach of central bank digital currencies, how likely is it that private sector cryptos will simply be banned? Governments don't like competition, especially if social credit scores are the next step.
CBDCs, central bank digital currencies, are undoubtedly coming. The Chinese one's coming in a couple of weeks, I think. But they're all working on it. The ECB, the Fed, etc. ByteTree was the UK one that was mentioned a few months ago. To be honest, I think they're seeking to solve a different problem, and it's far too easy to sort of conflate them. But if Bitcoin is a digital store of value, digital gold, an option on a future store of value, whatever you want to call it, that is not what any of these CBDCs are trying to do. They're trying to replace the current fiat currency, and presumably sort of increase government visibility or oversight of what goes on within the banking system. So I sort of view them as a bit of a red herring. But at the margin, I would say they're probably positive in terms of normalizing the idea of digital currencies.
Yeah.
Charles, would you disagree?
No. I mean, on central bank digital currencies, I wrote a sort of open piece. It's on the ByteTree website to the Chancellor. I was requested by Steve Baker MP to do that, and put some arguments together as to why. And I think that there's a couple of arguments. And one was the whole snooping side of it. The data snooping side is just not British. And it might not be that the current government is the one you've got to worry about. Can worry about the current government on many issues, but not on data snooping. And but maybe a future government comes along. And the other thing was just incompetence. Do you trust the government with tech projects? Would you want the Bank of England's reputation on the line with digital money? And what if they ballsed it up? So those were some of the simple arguments of why you wouldn't do it. It's free society shouldn't be looking at these things. But yes, digital fiat monies should be all over the place in the future. But the private sector's job to do them. That was our simple conclusion.
Mm-hmm. Moving swiftly onwards, this brilliant observation from Russell Napier last time about broad money growth driving inflation through the sort of fractional reserve banking, I guess. Not interest rates. Do you agree with him that the Fed is basically impotent?
So I would highly recommend that people do go back and watch Russell. We know him well, but I thought he was on particularly good form when he was on your webinar a few weeks ago. I have sympathy with his view. I'm not quite as highly convicted on it as he is. He is very, very strongly of the opinion now that central bankers are impotent and that fiscal policy has taken over. We definitely think fiscal policy has a much larger part to play. But I still think that the sort of the blurring of, we talk about the blurring of monetary and fiscal policy and the fact that central bank independence is effectively over. I'm very confident saying that. I'm less confident saying that central bankers are impotent.
Yeah,
especially to their face.
Well, it'll be fascinating. I mean, as we rightly said, with oil sort of steaming through $90, it'll be interesting to see how those sort of prices react to any Fed actions.
Yeah, I mean, I think we didn't just talk about it, but it's the most interesting time right now in markets, because I published an article yesterday on CityWire. The Fed are between a rock and a hard place. I do not see what they do. They've got to tap the brakes. They've got to well, they've got to hit the brakes hard enough to slow 7% inflation from a point where real rates are -7. They've got to do this huge amount of tightening. They've got so much liquidity to withdraw from the economy. One of the charts that I don't think you brought up yet is the Goldman Financial Conditions Index is at all-time lows. We've never had it so easy, and the economy is booming and inflation is way above target. So the Fed have to do something. But as we're seeing in the first couple of weeks of the year, as soon as they even hint at tapping the brakes, the very high duration, highly financialized market starts to wobble. And what do they do?
So Duncan, just to highlight your point, when I was a bit younger, central bankers used to talk about the Taylor rule.
Yeah.
If you implement the Taylor rule today, you'd see interest rates go to 9%.
Exactly. I mean,
everyone would be living on the street with 9% interest rates who had a mortgage today.
Yeah.
Yeah, absolutely. What else we got? I think we're largely through it, really.
Well, there's some very good ones from the beginning. Meteoric growth and Web3. You've kind of touched on that, haven't you? With saying that's not really a Ruffer thing. That's a sort of venture capital.
Yeah. I'm sure you can find someone better placed to answer those questions than me.
What everyone wants to know, really, does Bitcoin and crypto go with the kind of exponential asset NASDAQ, Cathie Wood, ARK world?
Well, yeah, I think
So
our concern would be yes. So at the most macro level, it's very clear now. I think. Well, we'll see what Jerome Powell says in a couple of hours. But we're in a Fed tightening cycle. And maybe the first proper one of my career. So rates are going to be going up. Quantitative easing is melting into quantitative tightening, and that seems like a highly unfavorable environment for the biggest beneficiaries of liquidity. Now, the biggest beneficiaries of liquidity, you could argue, are unicorn, profitless tech, and crypto. So that's the withdrawal of liquidity definitely made us concerned, and that's why we exited when we did. But also, there's just so much froth in the sector, and I love all the examples. It does feel to me like I'm living through 1999, even though I wasn't there. This feels like the new one. The Matt Damon television advert, the stadium sponsorships, Crypto.com spending $700 million on the Staples Center being renamed, sports stars wanting to be paid in cryptocurrency. You guys will remember when the supermodels wanted paid in euros, not dollars, marked the exact top of that exchange rate. There's so many anecdotes. The NFT that sold for $5 million on the same day as a Picasso sold for $4 million. People quitting their jobs to trade crypto every day, as day traders. And one of my favorites shows the scale of the money that's been made. 1 in 5 house deposits is now funded by cryptocurrency profits, or at least that was true until 2 weeks ago.
Yeah, well, I was reading something fascinating yesterday, which was about the tax implications of that in the US for a lot of people, because if you've been paid in crypto at 60,000,
that was Odell Beckham Jr., the white.
Yeah, that's right. And I think for a lot of people, this is going to be very, very problematic. It's a classic first quarter problem actually for crypto, and it tends to underperform.
Yeah, he will if the Bitcoin price falls to about $30,000, he will end up paying money to play this year because of the conversion and net of tax. He gets half his salary in Bitcoin, but that's fallen, but he gets taxed on the full amount or whatever. But yeah, someone did the maths, and it's not very good for him, poor chap. And this is the problem. $1 million contract means I don't have much sympathy for him.
Yeah, and of course, this is the problem with inflation as well. It's just very corrosive in terms of people's ability to spend. Discretionary spending, which I guess is a lot of crypto speculation, so in emerging markets.
Yeah, I think the one variable that I would really keep an eye on for the year is the labour market. I think that we've had this inflationary impulse. We're definitely seeing it in wages. You're seeing FedEx, Amazon, Tesco, all the big employers saying they can't get staff. Minimum wages are rising globally, but actually the clearing price for wages is already way above the minimum wage. My wife's about to go back to work from maternity leave next week, so we're interviewing for a nanny, and we had to pay someone to come and be interviewed. So, it's not just McDonald's that are paying people to be interviewed. It's now the standard, it would seem. So but there's, because of the rise in energy costs, because of the tax increases in the UK, there is undoubtedly a cost of living squeeze heading into 2022. So the battle is, can people get wage growth above the cost of living growth? And if you see the business surveys, many businesses are saying that they've got a record number of vacancies. The labour costs are rising, and the cost of that labour is their number one concern. And the sort of most remarkable stat maybe is that in Q4 we had a record low number of redundancies in the UK. Now, who would have possibly forecast that? Everyone was so worried about furlough ending, and a wave of redundancies, but actually we had a record low number of redundancies. So it just shows how hot the economy is and how far behind the curve we think central bankers might be.
Yeah, absolutely. Can I just make a point of going back to 1999? If you take ARK as your sort of I don't know, the poster child of 2021.
Yeah.
The way, here's my prediction. I want to hear yours, and it's that inside ARK there's some great stocks going forward 10 years. Most are probably not. Most probably go down 95%.
Yeah,
this is just what happened last time, but a few of them become Amazon and that sort of thing. The next round of great companies, and I just think that since the Bitcoin peak in 2017, Bitcoin's actually outperformed ARK, ever so slightly, and is actually falling less quickly over the because I think ARK peaked in around February or something, and Bitcoin's sort of doing a bit better, and I just think it breaks away, and I just think that some ARK stocks will do spectacularly well. The group won't do well at all, but Bitcoin will correlate, which means they rise and fall together, but over time will diverge and show some decent appreciation. I think that's easy for people to understand. They're just in correlation and performance.
Yeah, so I would with the full caveat that Ruffer has exposure to none of these instruments, no Bitcoin or ARK related stocks. I think I would agree with you. I mean, that sort of venture capital-esque payoff profile of, famously, Peter Thiel's 0 to 1. You've got 10 stocks in the portfolio in your venture capital fund. 8 or 7 go to 0, 2 do pretty well, and 1 is a home run. That's the shape of returns that he would aim for, and that most VCs aim for. I think that's probably likely on a 10-year view. But of course, which 5 of the 150 stocks or whatever are in the ARK Innovation ETF are the home runs? That's the skill.
Absolutely.
Duncan, we've used an hour of your extremely precious time. Thank you so much. I think we've really got through most of the questions one way or another. And thank you so much to everyone out there who's joined in and engaged with us. It's been a fascinating conversation. Long live gold and Bitcoin. It looks like this is just the sort of environment for both those assets, although the latter in its usual volatile manner. But there's a lot to think about from what you've chatted about today, and we're incredibly grateful to you for joining us. So thank you.
Well, thank you for having me, and good luck with the rest of the series. I hope I lived up to Russell's awesome start.
Absolutely. The quality just gets higher and higher.
Great. Thanks, guys. Thank you for everyone.
Thank you.
Cheers.